Morning, everyone, and welcome to the High Street webinar on the Global Balanced Fund. We have a broad audience of clients, IFAs, and potential clients, and we aim to cover everything relating to the fund without taking too much of your time. We anticipate that the presentation will last approximately 30 minutes. My name is Mike Patchitt, the founder of High Street and the fund manager of the Global Balanced Fund. With help from Ross Beckley on my left, the Chief Investment Officer, and more recently, our research team, headed up by Ross Yammin on my left. Both will be talking during the presentation. In 2011, having left corporate life behind, started managing my own assets. It was then that a number of friends approached me to manage their assets the same way as I did mine. Ross Beckley joined me in 2012, and it's incredible to believe that he's worked at High Street for 9 years. He's the major shareholder and the chief investment officer of the business. We obtained our FSP license in 2014, allowing us to manage third-party money. We immediately applied, and it took some time, but received our approval from the Central Bank of Ireland to manage mutual funds listed in Dublin. Our global equity fund called Wealth Warriors was launched in late 2017, and we pooled and listed all our bespoke portfolios into a local balanced fund in 2018. Murray Stewart bought into the business as a major shareholder in 2019, bringing with him a wealth of knowledge from the years in investment banking. We have spent the best part of 3 years developing our research capacity known as the highway process. The investment process initially developed by two CFA charter holders, Ross Beckley and Charlie Della Pasteur, and more recently, Ross Yammin, Vicky Khan, and Christopher Brownlee, who are all CFA candidates. We currently manage 1.4 billion in assets, as we like to say, $95 million. What we're going to talk about today is the Global Balanced Fund, listed in 2015 on the Irish Stock Exchange, a fund designed for South African investors with a moderate risk appetite who want to diversify away from South Africa and invest in the biggest and best companies in the world. We see ourselves as offshore and rand hedge specialists, and the main aim of our structure is to focus on the managing of assets in 3 pools, be a small and focused team with a robust investment process which removes key man risk. Just to summarize, the 3 funds are the Global Balanced Fund, which currently is a dollar-based fund, which is 55.8 million in size and administered by Sanlam. We have a local balanced fund listed in South Africa, which is 207 million in size, a Regulation 28 fund with 93% exposure to offshore assets, and it also administered by Prescient. The third fund, the Global Equity Fund, known as Wealth Warriors, it's a dollar-denominated fund, which is 25.4 million in size. It is 100% equity and higher up the risk curve than the other 2, invested in disruptive industries and administered by Prescient. All the funds are approved by the FSCA. They have daily liquidity, and there is no performance fees attached to these funds. In a new development, we have applied to have the 2 dollar-denominated funds listed as feeder funds in South Africa, and which allows investors to invest in rands into those funds without using the asset swap capacity. Now, if we go to the Global Balance Fund, the fund objective of the fund objective is to achieve US CPI plus 3 to 5% per annum over rolling 3-year periods. If we look at the average inflation rate over the last 12 months in the US at 2.2%, if we add the average of 4% to that, we would hope to achieve 6.2% over the last year in the Global Balance Fund. The target market, being moderate risk investors, would include living annuities and trusts who would apply to get their money out through asset swaps. As you know, living annuities fall outside of Regulation 28, and if you're over 55, one can invest 100% of your living annuities into these dollar-denominated funds. Then again, we've got offshore companies and individuals. Individuals would either invest directly or through asset swaps, but with the feeder fund potentially being listed shortly, one could put rands into that fund. I would like now to pass on to Ross Beckley to cover more of asset allocation of the Global Balance Fund.
Thank you, Mike. Mike spoke to the fund objective of achieving US CPI plus 3 to 5% per annum over a rolling 3-year period. To get a sense of how we achieve this, we have to first consider the investable universe. Equity markets have been very strong of late, trading at all-time highs. However, we know that equity markets don't just go up in a straight line. I'm picking my period here, but had you invested in the equity markets as defined by the MSCI All Country World Index in 2007, it would have taken you 9 years to break even on your investment. That said, from 2016 to where we are today, the market has been very strong. So over the total period from 2007 until 2021, the market produced a return of 6.09% per annum. Looking at the property market, the break even took even longer. Had you invested in 2007, it would have taken you 13 years to break even. That said, just like the equity markets, the property markets have been quite strong of late. Although, when looking over the total period from 2007 to 2021, it's only generated a return of 2.62% per annum. If we dig into the individual asset classes, over an extended period of 3 decades, the differing return profiles become evident. Starting with cash, the annualized 3-year returns average 2.89%, with a very narrow range between minimum and maximum returns. Moving on to bonds, bonds generated 5.38% per annum, a bit of a wider range, but still not many 3-year annualized periods of returns below 0%. Moving on to equity, we can see an average of 7.78% with the range widening. And surprisingly, property produced the highest annual return across the asset classes of 8.11%. However, this was achieved at a wide range, including a 3-year period where annual returns averaged just 25%. Using a combination of asset classes, we were able to formulate a balanced fund that generated the highest risk-adjusted return, as shown in the middle by our High Street Theoretical Balance Fund. We acknowledge that the constructed fund is theoretical and generated with a clear view of hindsight. However, using a period of 3 decades gives us an idea of how the asset classes interact. The theoretical fund produced a near equity-like average return with considerably less volatility. The theoretical fund we produced allowed us to set ranges for a number of asset classes in order to achieve our objective of 3 to 5% per annum over rolling 3-year US CPI plus 3 to 5% per annum over rolling 3-year periods. We seek to maximize risk-adjusted returns. Equity was set between 40 to 70%. Property was set between 0 to 30%. Bonds and preference shares set at 0 to 40%, with cash and other set between 0 to 15%. Looking at the fund's current asset allocation, two figures will jump out at you. Firstly, equity exposure of 72%, as shown near the top left of your screen, for a balanced fund is quite high and outside the range that we set as prudent to achieve our objective. At the same time, we have 0%. We currently have 0% exposure to bonds, which sets us apart from the classic balanced fund, in which they hold an approximate 40% allocation to this class. Ross Yammin will speak to how we utilize equity bond proxies to fulfill the role of a traditional bond, which seeks to generate a steady income stream and reduce fund volatility. So within the equity component, approximately 15% can essentially be attributed to the bond component, with the remaining 57% following a strong pro-growth bias, which epitomizes our house philosophy. Worth noting is a 10% cash allocation towards the bottom right of your screen. 5% of this is tied to our protection strategy, and the remaining 5% has since been allocated. It is our policy to hold close to zero cash over time. Yam, over to you. Maybe you can move on to the bond proxies and how we approach our growth equity.
Thank you, Ross, and good morning, everyone. As Ross said, the purpose of me being on the call this morning is to go into a little bit more depth into some of the concepts which he's alluded to. What we're going to do is we are going to go through an example of a bond proxy first, and then we're going to go through an example of a growth stock to give you a little bit more insight into our research process and the purpose that these investments have in the portfolio. So we'll begin with an example of a bond proxy, and the holding which we will zero in for you today is British American Tobacco. When our research team looks at bond proxies, what we are seeking is stocks with significant sustainable dividend yields, strong balance sheets, and companies which have shown resolute share prices in adverse economic environments. Currently, BATS has an annual dividend yield of 7.96%. In a world where American 10-year bond yields sit a little over 1%, I think that you'll agree with me that this nearly 8% annual yield that we can attain from BATS is relatively attractive. When looking at how sustainable this yield is, we look into a company's financial standing and their ability to generate cash flows. As can be seen from the chart in front of you, over the last 21 years, BATS has consistently increased its dividend, and through major global crises such as the global financial contagion, which happened in 2008, as well as the more recent COVID-19 related sell-off at the beginning of 2020, the company has not been forced to cut its payment. From a consistency perspective, this is quite a remarkable record. Turning to cash generating ability, over the last 12 months, British American Tobacco has had a cash conversion ratio of 123%. And it's this cash generating ability which really gives us confidence that the business will be able to continue to return significant capital to shareholders going forward. Then to the balance sheet. Since BATS completed the Reynolds acquisition in 2018, the business has carried a slightly elevated level of debt compared to its history. It is that increased level of debt that it's carrying on its balance sheet, along with a couple of regulatory issues which they had at the tobacco market in America that led to the drawdown in 2018, which your eyes probably would have been drawn to on the graph in front of you. But with that being said, the interest payments on this elevated level of debt are significantly well covered by cash flow. And when you look at the company's repayment schedule over the next 6 to 7 years, it's fairly consistent without them having to have to dish out a massive amount of cash in any one year. And so we are confident that the company will be able to meet its debt obligations going forward, even in times of economic stress. Finally, it's important that in adverse economic environments, the share has not seen enormous volatility. After all, we are valuing these kind of stocks relative to bonds, and so low volatilities in adverse economic environments is crucially important. In front of you, you've got the graph of BAT's share price over the last 21 years. And during this period, there have been a number of notable financial events. The global financial crisis in 2008, the bursting of the dot-com bubble between 2000 and halfway through 2001, and more recently, the COVID-19 sell-off at the beginning of 2020. As can be seen, due to the addictive nature of BAT's products, as well as its geographically diverse customer base, the share did not see big sell-offs during these periods of crisis, with the biggest drawdown being during the global financial crisis and being 17%. And it's at this point that I would like to draw a comparison to 10-year yields again, as if we were to see the yield on the American 10-year US government bond go back to the level at which it was in November of 2018, we would expect to see the prices draw down of these bonds by about 17%. So to the same extent that we saw the BAT share price draw down during the global financial crisis. Thus, by purchasing defensive, high-yielding equity, we feel that we have come up with quite a prudent way to generate yield at risk levels which are not much higher than those that one is exposed to in the significantly lower yielding US government bond market. So that's a fairly broad overview of some of the important things that we look for in our bond proxy investments. Yield is crucially important for any global balanced strategy, but is arguably even more important for our strategy, as it is this yield which enables the fund to pay for its downside protection, which Ross is going to talk to in a few minutes' time. Then looking outside of bond proxies and to the greater equity market, and what we look for in our growth equities in the Global Balanced Fund is compounding cash flows, which we can purchase at reasonable prices. In looking for such opportunities, we come across some of the world's leading growth companies. These companies are crucially important to the fund as they provide the fund with some upside. And as a research team, they are the companies which we particularly enjoy looking at. Today, I'm going to use what I believe to be one of our best ideas as an example, and that's Facebook. So when looking at growth stocks, we look for meaningful top-line growth, high return on invested capital, superior financial standing, and then finally, we look at valuation, as we do not want to overpay for growth. As you can see, historically, Facebook has shown a tremendous ability to generate growth on the top line. The graph that you have in front of you starts at the beginning of 2015 and finishes yesterday. And over this period, the company has been able to generate an annual revenue growth of 37% every year. Quite remarkable figures. Through the company's social networks, it has created an enormous online audience for ads, reporting that it has 2.8 billion monthly active users in its last results presentation. With the monetization of WhatsApp on the company's horizon, as well as with lockdowns having highlighted the utility of personalized ads and their importance to small and medium-sized businesses globally, there is no reason to believe that this growth should slow down at any time in the future. This is not just our opinion, with Wall Street analysts predicting that the company will continue to grow its revenues at an annualized rate of more than 20% over the next 5 years. The company also has a tremendous track record of exogenous growth, as they have proved to be brilliant allocators of capital. The best example of this would be Instagram, which the company purchased for $1 billion in 2012, and which this year is forecasted to bring in more than $18 billion for the group. Finally, a last note on valuation. As I mentioned, we do not want to overpay for this growth. And so when valuing companies such as Facebook, we use a blend of traditional metrics, as well as High Street's own proprietary valuation model. Of the traditional metrics, the ratio which is probably the most important to us is the PEG ratio, as it gives us an indication of pricing relative to growth. And on a PEG ratio basis, Facebook is on the cheaper end of the tech world and remains relatively well priced compared to its history. According to our proprietary valuation model, we expect to receive market-beating returns over the next 5 years from Facebook. The extent of this expected outperformance is attractive and exceeds most of the other big tech names which we have within our investment universe. So to conclude, I hope we've given you an idea of the kind of research that is going on behind the scenes on the balance fund. And through the examples, you have a better understanding of the importance of both bond proxies as well as growth stocks to the portfolio strategy. And with that, I'll pass back to Ross.
Thanks, Jan. Even though we consider the fund's equity bond proxies to essentially be comparable to vanilla bonds, we still consider the equity component too high without employing other strategies. So what we aim to achieve is to mitigate potential losses on the equity component. First, we must look at historical drawdowns in the equity market. A drawdown relates to the maximum loss endured from a market peak to a market trough. Otherwise, many will term as a correction. As can be seen, the average drawdown over the past decade has been 13% per calendar year. The drawdowns have consistently been close to the average over the decade, except for that of last year, resulting from COVID and the lockdown measures. The market declined 32%. With an average drawdown of 13% in mind, we can implement a protection strategy to mitigate adverse market movements. In February 2021, we increased our equity exposure to 73%, largely as a result of replacing our vanilla bond exposure with equity bond proxies. We also implemented a protection strategy. Although the strategy cost the fund 1.5%, it was almost entirely covered by the incremental yield we received from our equity bond proxies, as Jan mentioned earlier. The bar chart on the screen shows the projected fund returns under various market scenarios. The light green bar chart being the expected fund return excluding protection, whereas the darker green bar shows the expected fund return including the protection we had in place. A market decline of 20% was forecast to result in a fund loss of 12% after all costs. Essentially, the protection strategies in place meant that we only expected to see 60% of the downturn. A market gain of 20% on the far right was forecast to result in a fund gain of 15.6%. Essentially, we would still be able to capture 78% of the equity upside. A return profile where we expect to participate in 78% of the upside and only endure 60% of the downside is exactly what we aim to achieve within the fund.
Right, looking at performance, obviously an important factor in determining whether you want to invest in this portfolio is determined by our asset allocation in equity, bonds, and property over time. And within the equity segment, we have to decide whether to be in growth value or discounts to NAV stocks. If we look at the blue line, that's what we want to try and achieve in terms of our fund objective, US CPI plus 4%. And over the last 9 years, you can see what that has done. Just looking at High Street and the fund, we are happy that we are above that line over a 9-year period. And then we have a look at our benchmark. And as you can see, lately we have underperformed relative to our benchmark. And I think there are two important factors. One being our relatively high exposure to China, which Ross Beckley is going to talk about shortly. And secondly, Ross spoke about the participation on the upside because of our hedging strategy. And as a result of the market rising, we have slightly underperformed because of our protection strategy. Morningstar, which is a Chicago-based investment research fund, ranks all publicly traded mutual funds on a rating of 0 to 5 stars. And we are proud that we are rated a 5-star in this fund and have been so for some time. Just talking about our benchmark, which is basically a normal balanced fund portfolio, which is divided between equity, bonds, property, and cash, which compares us to our competitors. And obviously, performance, one has to take into account the risk-adjusted return. And here again, we talk about our risk mitigation that we use hedging during the majority of our investment horizon. If we look at our, there we go, our geography exposure. At the moment, we're currently 37% invested in the United States, 20% in China, 9% in Canada, 7% in the Eurozone, and 6% in the United Kingdom. What we tend to do, because we are a US-based dollar fund, if the exposure of any currency outside of the dollar is more than 10%, we look to hedge by forwards or by options, depending on our view on the currency. Obviously, the Canadian dollar, the Eurozone, and the United Kingdom, we're not hedging at the moment. And then the China, it's obviously Hong Kong based, and there the US dollar is directly linked to the Hong Kong dollar, is directly linked to the US dollar, so we don't hedge there. But what I want to do is to pass on to Ross to discuss our exposure to China. Thanks, Ross.
Yeah, so July proved to be a testing month for the fund, following intensifying regulatory scrutiny in China, which resulted in some sharp share price declines. Having an 18% exposure to this region detracted almost 2% from the fund, while the benchmark was largely unaffected due to having a negligible Chinese component. Looking at the chart, first on the left, sharp corrections are not entirely uncommon in China. And even looking at the chart on the right, these market corrections are not that uncommon in the US. Many of the big US tech names have endured similar rapid declines, followed by equally swift recoveries. If we have a look at Facebook, we've seen that towards the end of 2018, their share price came off almost 45%, but the recovery was equally as swift. It is our view that the world is too intertwined and there is too much at stake for the Chinese government to simply implement draconian regulation. The butterfly effect would immediately negate the gains that China has fought so hard to secure over the past 3 decades. Given our constructive outlook, we took the opportunity to increase our Chinese big tech exposure within reasonable bounds. Our valuation model accounts for heightened regulatory risk and still implies market-beating returns off these levels. Since implementing these trades, we have already seen a material recovery in the share prices.
If we look at our comparative analysis, as we were listed in 2015, we look at a 5-year comparative performance of ourselves relative to the average of the 5 largest competitors that also manage dollar-denominated balance funds offshore. And as you can see, our total expense ratio of 1.33 versus our competitors at 1.51. We see ourselves as achieving a return of 8.43 relative to our competitors of 7.8. So on a cost basis and a performance basis, we are delighted with the outperformance. We also have that is the retail class in terms of the total expense ratio. We also have an institutional class for investors that invest more than 15 million with us, and that is about 1.02% currently. We also have an IFA class. If we look at the highlights of the presentation, I think performance to us is important, and we are delighted with the 5-star Morningstar rating. In terms of downside mitigation, we do use derivatives, which detracts a bit from performance, but in total, we have outperformed our objective in terms of the US CPI. I think we are really nimble in nature, and the team, which we have tried to concentrate on the research capacity, and hopefully within a year, we will have 5 CFAs establishing a sound investment process. As with our clients, we like to tell everyone that we are personally invested in the funds, and the most important thing is that we're approachable if anyone wants to ask questions at any time and book meetings to see us and speak about the portfolios and the performance. To end off, what we want to do is just to show our top holdings in the equity and property sector, and we would welcome any questions that anyone has on the presentation.
Okay, so we've got one question coming in regarding banks, saying, I see in your holdings on the slide in front of me that you have JP Morgan and Morgan Stanley. What is your opinion on US banks, and will you look to hold them going forward? I think I'll take that one. When it comes to the US banks, we bought them at the end of last year, where we had a situation where the banks were grossly overcapitalized, and the regulators in America had prevented the banks from being able to pay out their excess levels of cash back to shareholders in the form of dividends or buybacks, or from going after acquisitions as well. And we looked at these companies which were grossly overcapitalized, and we said, well, they are going to have to be able to return this capital at some stage to investors. And so that was the reason we bought them in the first place. Since then, we've seen this sort of trend continue, with the regulator then coming out to allow us to allow the banks to give capital back to shareholders, and the banks have seen a fundamental re-rating as a result. We've done really nicely out of the banks. The 3 banks which we hold in the portfolio at the moment are JP Morgan, Morgan Stanley, and Bank of America, and I think we hold them each for a slightly different reason. JP Morgan we view as a proxy to the American economy as a whole. It's, in terms of its performance ratios, it's probably the best performer of all the big banks in America, and thus, as a sort of global balance fund type stock, it fits the mandate really nicely. Bank of America stands to disproportionately benefit from an increase in yields in America, and so that's sort of why we hold Bank of America at the moment. We see yields having the capacity to beat on the upside of expectations as to where they currently are. And then finally, with Morgan Stanley, we really like the management of Morgan Stanley, and we like their transition towards wealth management in the investment bank, which they've shown a record of outperformance in recent years. So although we hold each bank for a slightly different reason, they all play into the sort of broader theme of financials really nicely, and fit the fund quite well.
Fantastic. Thanks, Yam. We also have a question saying, what do you look for in a property stock? In terms of the fundamentals, from a top-down macro perspective, we have to consider interest rates. In the short term, I think that has the most meaningful impact on share prices. In the longer term, though, it all comes down to GDP and inflation. As such, if there's GDP and there's inflation, and these companies have pricing power to push through top line rental growth, this is attractive. Top line rental growth then leads on to efficiencies seen in scale, and then we can see the FFO, basically a cash flow metric, growing nicely. So typically we want a company that's in a facing high occupancies, low vacancies, and are able to push these price increases through. Then in terms of evaluation, in terms of valuing the stocks, we compare those to the relative government bonds in those regions, and then decide what spread is applicable to that company. That spread will be dependent on the financial standing of the company, the age of the properties, single exposure to one tenant, etc. We then pull that out 3 years and come to an IRR, which we think the stock can generate when we add the dividend yield to that. So at the moment, we have a lot of property in sectors in the industrial sector, which has performed very nicely. I mean, Sirius we've held for 8 years. I think, Mike, we got in at 15p.
Correct.
And that's performed very, very nicely for us. We still see them as engaging in, we still see them as having room to grow, to engage in their recycling program, able to acquire properties on relatively high yields and low occupancies, and then they can amalgamate that into their platform and extract value.
But generally, low interest rate environment suits these property stocks that are getting reasonable yields and are growing because they are the industrial warehousing sector and are doing very well because of the Internet of Things and online shopping, basically, the growth in online shopping.
Okay, next question. Can you give a quick précis of the NASPA's process relationship, and why have you chosen to hold NASPA's as opposed to process? If we talk about process, because NASPA's is just a holding company of a holding company, so the direct company being process, we can see that about 80% of their NAV is held through their stake in Tencent, with 20% being made up of various businesses, including fintech, classifieds, food delivery, and most recently EdTech. There's long been a market belief that they've been poor allocators of capital. We disagree. They've seen high IRRs out of their businesses, which they've since spun off. They recently sold Flipkart in 2017 to Walmart. And then over that 2-year period, the Flipkart valuation went on to double. They've invested in delivery Hero. That's performed very, very nicely. It did roughly 80% last year, and now accounts for roughly 15% of the assets outside of Tencent. So we take an opposing view to the market, and we don't feel that they should be penalized for their capital allocation abilities. So if we look at when considering a holding company, we need to look at the discount to net asset value. Currently, we have NASPA's trading at an approximate 51% discount to NAV, and we have Process trading at an approximate 38% discount to NAV. We believe a fair discount, a fair spread between the two discounts is about 15%. Historically, it's traded between 10 to 20%. However, with the corporate activity that's happening, should it go through, investors will have the opportunity to switch out of NASPA's into Process. We have chosen to take up the offer, as we are not subject to capital gains tax within the fund. and we believe the deal is being struck at a 9% spread. So there's quite a lot of value uplift switching into process from NASFAS. Ultimately, we are able to invest in Tencent, and it still makes up 80% of the NAV through either a direct investment in Tencent process or NASFAS, and we can trade on that discount without incurring capital gains tax. So process is our favored entry into Tencent at this stage, and at a discount to NAV of 38%, we still see that as too wide. We see a fair discount at around 25%. Not to mention what's happened to Tencent on the back of this China crackdown. Tencent is trading at a 21 times forward PE. Yeah. So very, very cheap. And we don't believe that there are existential risks to the investment case. So we are very bullish on process at these levels, and it makes up a significant component of the fund.
If I can answer Spalding Fareed, thank you very much. In terms of statistical metrics, I wonder if I can get back to the later stage on that. It's quite technical, and maybe we can email you regarding that question. But in terms of the benchmark, we're happy to remain, even though our China exposure is high, we're happy to be compared with the benchmark that we have in existence, because we want to outperform that benchmark, and we do think that China over a 6-year period going forward will show better growth and will outperform our benchmark and the equivalent shares that are within the benchmark that we think we will beat. If we can move on to maybe Peter Obenheimer. Ross, do you want to take that one in terms of China?
Okay, given that you are confident that China cannot increase regulations as it will undo what they've achieved for 30 years, why have they done what they have to cancel listings and apply pressure to gaming? So Pete, interestingly, we're sending out a document to investors where we go into some detail about China, what's happened, why we don't feel that it is an existential threat. There are two issues at play here. One is regulation, and the second is the viability of the structures, the VIE structures, as well as what government does in terms of attacking an industry. So we saw with after school tutoring, the government went after them, essentially forcing them to convert to a non-profit business model. However, we don't feel that they are going to enact sweeping changes across the board. We feel they are simply catching up to the Western world. I mean, just the other month, we saw Google, Alphabet receiving a fine of $500 million from the European Union. Not much noise was made of that. With these big companies with dominant market shares, we feel that is simply a cost of doing business, because they are skirting on the line with the regulators. Alibaba was fined $2.8 billion. However, they generate that amount of money in free cash flow in just over a month. So we think it's a cost of doing business. China is simply catching up to the rest of the world. And in terms of canceling listings, we don't see that as a threat. Yes, they have gone after the education sector. However, if we look at their 5-year plan, social equality is a major feature. And spend on after-school tutoring, these education companies accounted for approximately 20% of household expenditure. So in hindsight, we did have some exposure there to that sector in Wealth Warriors. In hindsight, it's as clear as day because fertility is an issue in China and population growth is a key priority. However, we feel if you invest in line with the CCP ideals, they are not simply going to pull the rug from under you. There's too much at stake here. The market value of the US ADRs is approximately $1.5 trillion. And we feel any drastic action there would be tantamount to economic warfare. So we don't see that happening. Yes, we could see further pressure in gaming, just like we saw in 2018. At the time, the Tencent share price came off roughly 45%, as I showed in that image in the slide. However, the recovery was very swift. We do feel that they're going to regulate the sector. However, we don't feel that they're going to hamstring the sector. So growth may come down in order to comply with the regulation. There are costs and also it reduces your market. However, we still feel that there are decent growth opportunities for these companies, with Tencent expected to grow revenue by 20 to 25% over the next 5 years, per annum over the next 5 years. So we feel regulation is a worry. However, the sentiment has spilled over to existential threats, as you mentioned, simply delisting these companies. And that has provided an opportunity to increase our exposure here.
Ross, if I can just add on the gaming particularly, the regulations which have been proposed and which have been in the media, which I'm sure are what you're referring to here, refer to children and children spending too much time gaming. From Tencent in particular, the under 18 age group makes up less than 6% of their revenue over the last 12 months. So it is not necessarily a massively enormous part of their revenue makeup that would really concern us.
Thanks. If I move on to the next question, which is on returns in terms of asset allocation, what's contributed most, I think, in the last year, I would say that our overweight banks have performed extremely well for us in terms of property, sticking to industrial property and sticking away from retail has performed well for us. And in particular, our low weight in bonds, I think have been the best in terms of allocating assets. In terms of what's detracted from us, and I think, initially we were a cash plus fund before 2016, where we adjusted the portfolio to more balanced fund. And Brexit, I think, which was early 2014, if I'm not mistaken, was a big detractor. We had a very high weighting in high yielding equities in the UK, and obviously the currency and the sharp drop in the assets in the UK negatively performance. That was negative for our performance during that period. So hopefully that answers that question. Sorry,
just a question above there that we passed. What are your views on the clickbait messages that we are in a market bubble? So we've seen with, I guess, the most widespread financial metric to assess where the markets are at is a trailing PE ratio. We saw the trailing PE ratio for the S&P 500 go up to above 30 times. However, today where we stand, the forward-looking PE on the S&P is 21. That is not overly elevated compared to historical norms. It's been around 17. However, we are in a very low interest rate environment, and capital has to go somewhere. So in terms of asset classes, we still see equity as offering the most value. However, it is quite nice that within the balanced fund, we can employ downside protection strategies. So And if we look at the big 5 tech names in the US, we see meaningful upside for these companies. Their results have just been staggering over the past year, what they've been able to achieve. And still, we have these companies trading on mid-20 PE ratios and growing at significant rates. I would say last comment there would be attempting to time the market is not our thing. We don't believe it can be done, or at least we can't do it. So we like to remain near 100% invested. If I had asked someone how the market was going to perform, maybe in April, May last year, no one would have, well, very few people would have projected the returns that we've seen over the past year and a bit. So we believe the market is a little bit above, is a little bit elevated compared to history. However, in terms of asset classes, I think equity is still the place to be.
Thanks. Sorry, there are quite a few more questions. If you don't mind, can we email those people who have asked those questions, because there are a number of them. We don't want to carry on for too long, but if you can hold out, and we will answer those questions directly by emailing everyone all those questions, if that's okay. And we end right now, if that's okay. Thank you very much for spending time with us. And this presentation will be available on our website, and we will certainly answer all the questions that have come up. Thank you very much indeed. Cheerio.
Thank you.